Hello guys, and welcome to my journal for Friday the 18th of September. It was a bearish day in the markets today, and all the major averages were down by around 1%. And it's worth noting that the Nasdaq is now in correction territory. So the Nasdaq is now down more than 10% from the recent high it printed only a few weeks ago. Looking at the safe haven assets, gold was up today, silver was down, and the US Treasury saw yields rise as money flowed out of treasuries. The dollar index was flat on the day, and it closed at exactly 93, which is a key level for the dollar index. The VIX was also down. It closed at 25.83. So the VIX is still consolidating above the 20 level. And in summary, the markets painted quite a confusing picture today. Equities were down, gold was up, silver was down, US Treasury yields were up, the dollar was flat, and the VIX was down. So there's no very clear picture from the price action in the various markets today. But the one thing that is clear is that there is some sort of rotation going on in the equity markets. A rotation out of the growth stocks into value stocks. The value stocks have been picking up while the growth stocks have been falling. But we need some more data points next week to get a clearer picture of what the macro theme is, if you like, a clearer macro picture. Now, before moving on to positions, I want to cover a topic that I have delayed covering until now, and that is the risk of assignment on options. And the reason I have delayed covering it is because I didn't want to cover it as a hypothetical concept. So all the trade ideas I've put on prior to the September contract have been plain sailing and pretty straightforward. Basically, I've been selling the spread, set my profit target gets hit, and I take my profit. The issue of assignment risk has been hypothetical up until now, and it only just became a reality, or a real life concept, if you like, with the September contract. So what is assignment? Well, when I sell an option, say I sell a call option, I'm giving someone the right to buy the underlying stock from me at the strike price. If that person who bought the option I sold decides to exercise that option because it is in the money, then they'll simply exercise it via their broker, who will notify the exchange the option is traded on. The exchange then randomly selects one of those who sold that call option and assigns it to them to deliver on the contract they sold. Theoretically, this could happen at any time an option is in the money, but in practice it seldom happens outside the expiry week window, because exercising outside the expiry week means you're leaving some extrinsic value or time value on the table, and you would make more money by simply selling the option than exercising it. That is, leading into the expiry week, there is still some extrinsic value on the options. Going into expiry week, the time value evaporates and it makes more sense to exercise. However, there are some special occasions, corporate actions, when an in-the-money option with more than 7 days to expire could be exercised. A good example would be when a stock is about to go ex-dividend and you need to be holding the stock in order to get the dividend. Then you could get assigned even with 15 days to go if the option is in the money and the holder bought that option so they could hold the equity in order to get the dividend. but generally speaking, the majority of assignments will happen in the expiry week. Now, if the holder of an in-the-money option does not exercise by the expiry Friday, your broker would usually, or the broker would usually automatically exercise all options that are in the money by at least 1 cent. And they'll do that at the close of business on the expiry Friday. So that is what the assignment risk is and the mechanics of how it works. Now let me throw some real numbers at this thing, and I would use the ARKK trade as an example to demonstrate what that risk is in real life. So on ARKK, I sold the 1995 September call spread for $1.35. Last week Tuesday, ARKK was trading at $93, and there were 3 days until the September contract expired. My 90 call, in other words, was $3 in the money, and if I had been assigned on the 90 call, here is what could have happened. First, let's assume that I sold only one contract, only one ARKK 90 call. One equity call option is equivalent to 100 shares of stock, and I sold someone the right to buy ARKK from me at $90. If I got assigned on my short 90 call, excuse me, I would receive an email notification from my broker that my short 90 call has been assigned, which means I am now short ARKK at $90. One call equals 100 shares at $90, so my short is now 9,000. So one call is 100 ARKK shares at $90, so that is $9,000. My broker would deliver 100 ARKK shares to the buyer of my call at $90, and I would now have a short position of 100 ARKK shares. Assuming ARKK is still at 93, my position will be marked to market at 93, and I'll be showing an unrealized loss of $300 because I sold at 90, and it's now trading at 93, and I did 100 shares, so that would be an unrealized loss of $300. If I do not have enough equity or buying power in my brokerage account to cover the 9,000 short position I now have, I would receive an email from my broker informing me to post more collateral or to top up the cash in my account. In other words, I would receive a margin call. If for some reason I did not receive or read the email and post more collateral or add more cash to my account, the broker has the right to liquidate any other assets in my account in order to bring my account into credit. That could be other spread positions, or it could be equity positions, and they would simply close out the positions at the current market price. And if that still does not cover my exposure, my broker could use whatever equity there is to cover the short position at the market price. So let's assume ARKK is now trading at 94.5, and after my brokers liquidated my positions, I still do not have enough equity to cover my short position. The broker could then buy back my 100 shares at 94.5, and I would realize a loss of $450 plus any assignment related costs, and my open positions could be sold at a price which is unfavorable. It could be Tesla was going down at the time and they will just liquidate my Tesla position regardless of what the price is. And that is just on one contract. If you sold 10 contracts, that would have been an exposure of 90,000, because then you'd have 10 contracts where one contract equals 100 shares. So the reason for this illustration is to highlight the assignment risk and why it is best to avoid it where possible. And if you do get assigned, you now know how to deal with it, or you know what it means. One final point I'll make, if ARK was trading at 97 when I got assigned, if ARK was trading at 97 when I got assigned, in this case I would be safe, because if someone exercised the right to buy from me at 90, I would simply exercise my rights to buy from someone at 95, and the two would net each other off, because I'm long 95, which is my hedge, and my hedge would come into play here. And in this case, I would simply take the full defined risk or defined loss on the trade, which is the spread is $5. You get that from deducting the 90 from the 95. I sold the spread for $1.35. So my total risk in the trade is $365. 5 minus the 135 I sold the spread for. So this is the most I can lose in the trade with both options in the money. And I would simply take that, because someone would assign the 90 call, and I would exercise my 95 call, and that would be assigned to someone else, and the two would net each other off. So that is the assignment risk. Now let me go into my open positions. I now have 3 open positions in the October contract. The first one is BABA. On BABA, I sold the 260, 255 put spread. Let's see where BABA closed. So BABA Alibaba closed at 272.41. My 260 short put is out of the money by about $12 out of the money. Implied volatility is around 35, and on this one no action is required. And at the end of week 2 on this one, my P&L is positive P&L of $30 per contract. If I go to my portfolio tab and show you BABA, this is BABA. So my open P&L is $90. I did 3 contracts, so my open P&L is positive $30 per contract. The second position is in SE, SeaWorld. On this one I sold excuse me, the 125, 120 put spread. Let's see where SE closed. So SeaWorld closed at 147.55. I sold the 125 put. So my 125 put is comfortably out of the money. And again, no action is required on this one. My P&L on this one is $90 per contract. So on this one, this is SE. I've got an open P&L of positive 270. I sold 3 contracts, so that is currently positive $90 per contract. And the final position is in a PDD. On this one, I sold the 75.70 put spread, and PDD closed at 79.81. This one is also out of the money. The buffer on this one is not as much as it was on SE, but nonetheless it's still out of the money. My 75 put is out of the money by about $4.81, and I am showing a profit of $24 per contract on this one. Positive P&L of $24 per contract. That's PDD. Call that 72. Positive P&L. I sold 3 contracts. That works out about $24 per contract. So those are my open positions for the October contract. I'll skip the watch list today. I'll cover that on Monday, and that would bring me to the end of my journal for this week. The highlight to take away from today is to be aware of the assignment risk on in the money short strikes, particularly in the expiry week, and to avoid it where you can. There might be situations where it's unavoidable, but where you can, avoid it. In the case of ARKK, it was clearly avoidable, and that was why I decided to take the loss up front. I didn't close out the entire position. I decided to leave my long 95 call as a trade to nothing, which is still okay. I could have closed out the whole thing and reduced my loss, but I decided to take the long call as a trade to nothing, a roll of the dice, and it didn't work out in this case. And that brings me to the end of my journal. So have a great weekend, everyone, and I shall speak to you next week. Goodbye.